Introducing a beginner's manual on technical analysis, a comprehensive video series tailored specifically for those who are new to the world of trading. Whether you're just starting out or looking to deepen your understanding, this series is your roadmap to success. Throughout the series, we'll cover everything you need to know to get started with technical analysis. From understanding chart patterns to deciphering key indicators, each episode will equip you with the knowledge and skills necessary to make informed trading decisions. So, if you're ready to take the first step towards becoming a confident and successful trader, be sure to subscribe to our channel and hit that notification bell so you never miss an episode. Together, let's unlock the secrets of technical analysis and pave the way for your trading journey. Let's dive in. Hey there, fellow traders, and welcome back to Risk with Purpose, your ultimate destination for learning to trade with confidence and precision. I'm Technical Tiffany, and in this video, we will be exploring Elliott Wave Theory and market cycles. Understanding market cycles enables you to anticipate potential downturns or reversals, allowing for better risk management and capital preservation. Let's dive in. Lesson 2. Elliott Wave Theory and Market Cycles. Elliott Wave Theory, developed by Ralph Nelson Elliott in the 1930s, suggests that market price movements follow repetitive wave patterns driven by human psychology and crowd behavior. It's built on the premise that market prices move in recognizable patterns or waves, driven by the collective psychology of market participants. The idea is that market trends unfold in a series of distinct waves, which can be subdivided into smaller waves, creating a fractal pattern across different time frames. These waves give an idea of where an asset stands in the context of a market cycle. Wave theory. According to Elliott Wave Theory, market trends consist of 5 waves in the direction of the main trend, labeled as impulse waves: 1, 2, 3, 4, 5, followed by 3 corrective waves, labeled as corrective waves: A, B, C. This sequence forms a complete Elliott wave cycle. Impulse waves represent the direction of the prevailing trend and are characterized by strong momentum and larger price movements. Corrective waves represent temporary countertrend movements within the broader trend. They typically exhibit lower volatility and counteract the preceding impulse waves. Traders use Elliott Wave Theory to analyze market cycles and identify potential turning points in price movements. By recognizing the wave patterns, traders can anticipate future price movements and adjust their trading strategies accordingly. Elliott Wave Theory provides a framework for identifying specific wave patterns, such as extensions, triangles, and zigzags, which offer insights into the structure and potential duration of market trends. It also enables traders to make probabilistic forecasts about future price movements based on the expected progression of wave patterns. However, it's important to note that Elliott wave analysis is not deterministic and requires a considerable amount of subjective interpretation. Elliott wave theory categorizes waves into different degrees, ranging from grand supercycle to sub-minute, based on their duration and significance. Traders use wave counting techniques to identify and label the various waves within a price chart, helping to determine the current position within the overall Elliott wave cycle. Elliott wave theory is accompanied by several rules and guidelines governing the relationships between waves, such as wave alternation, wave equality, and wave proportionality, which help validate wave counts and patterns. Elliott wave analysis involves a lot of subjective interpretation and can be open to different interpretations by analysts. For me, personally, I tend toward the more objective tools, but nevertheless, it is necessary to understand at least the very basics of Elliott wave theory because the markets do move in cycles. Mastering Elliott wave theory also requires a deep understanding of wave patterns, rules, and guidelines, which can be challenging for novice traders. Market cycles. Market cycles are the recurring patterns or phases that financial markets go through over time. These cycles are characterized by periods of expansion, contraction, and equilibrium, and they are driven by various economic, psychological, and fundamental factors. Understanding market cycles is crucial as it provides insights into the broader market environment, helps anticipate future trends, and guides trading decisions. Here's a detailed explanation of market cycles. 1. Expansion phase. The expansion phase typically begins with a bull market characterized by rising prices, increasing investor optimism, and strong economic fundamentals. During this phase, economic indicators such as GDP growth, corporate earnings, and consumer confidence are generally positive. Investor confidence is high, leading to increased buying activity across asset classes. 2. Peak phase. The peak phase marks the climax of the bull market, characterized by euphoria, excessive speculation, and overvaluation of assets. Key indicators of a market peak include widespread media coverage, record high valuations, and extreme investor sentiment. Smart money begins to sell their positions, leading to distribution among less informed investors. 3. Contraction phase. The contraction phase begins with a bear market characterized by declining prices, pessimism, and deteriorating economic conditions. Market corrections or recessions may occur during this phase, triggered by factors such as economic slowdowns, geopolitical tensions, or central bank policy changes. Investor sentiment turns negative, leading to increased selling pressure and heightened volatility. 4. Trough phase. The trough phase represents the lowest point of the market cycle, marked by capitulation, fear, and widespread pessimism. Contrarian investors start to see value in beaten-down assets, initiating accumulation and bottom-fishing strategies. As selling pressure subsides and buying interest increases, the market begins to stabilize, signaling a potential reversal in trend. 5. Recovery phase. The recovery phase sees gradual improvements in economic indicators, investor sentiment, and market conditions. Positive developments, such as fiscal stimulus, accommodative monetary policy, or strong corporate earnings, fuel optimism and support a bullish reversal. Investors who accumulated assets during the trough phase benefit from the subsequent price appreciation. 6. Expansion/repeat. The cycle begins anew as the market enters another expansion phase, setting the stage for a new bull market and the continuation of the cycle. While market cycles vary in duration and intensity, the underlying patterns of expansion, peak, contraction, and trough tend to repeat over time. Market cycles are cyclical in nature, driven by a combination of economic, psychological, and geopolitical factors that influence investor behavior and market dynamics. Example: awareness of market cycles helps traders and investors tailor their strategies based on the current phase of the cycle, optimizing risk-adjusted returns. Understanding these market cycles enables you to anticipate potential downturns or reversals, allowing for better risk management and capital preservation, not to mention that market cycles provide opportunities for traders to capitalize on undervalued assets during troughs and take profits during peaks. And that's it. Thank you for joining us on this journey into the fascinating world of Elliott Wave Theory and market cycles. We hope you found this video informative and useful to you in your trading endeavors. If you found this video helpful, be sure to give it a thumbs up and hit the subscribe button below for more insightful content on trading and investing. Also, don't forget to leave a comment sharing your thoughts or any questions you might have. We love hearing from you all. And for those eager to dive even deeper into the world of trading, check out the links in the description for recommended resources and further learning opportunities. Thanks again for watching. And until next time, may your charts be clear and your trades be profitable. Happy trading!